Have you ever wondered why two investors can use the exact same strategy, make the same trades, and still end up completely with different results? The answer isn't stock selection, it isn't market timing, and it isn't technical analysis. It's position sizing. Position sizing is one of the most overlooked concepts in investing, yet it's arguably the most single important factor in determining whether you'll survive losing enough to achieve long-term success. In this video, we're going to explore why position sizing is important and how it matters to professional traders and how they think about it, and how proper risk allocation can help preserve capital while improving long-term performance. Hey, it's Frank Nagy. Welcome to my channel where we help investors understand various market environments, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. Imagine investing 50% of your portfolio in one single position. If that investment declines by 40%, your entire portfolio loses 20%. Now imagine risking only 5% on that same investment. That exact same market move now only has a modest impact on your overall portfolio. Nothing changed except the size of the position. This single concept separates disciplined investors from emotional investors. Professional traders don't begin by asking, how much can I make? They begin by asking, how much can I afford to lose? One of the biggest mistakes investors make is confusing confidence with certainty. You may have researched a company thoroughly. You may believe an investment has excellent potential, but markets are unpredictable. Unexpected news, economic reports, interest rate decisions, and geopolitical events can have a big impact, or simply changes in investor sentiment can quickly move prices in unexpected directions. No investment is guaranteed. Proper position sizing acknowledges uncertainty ahead of ignoring it. This is one of many strategies Beta Bridge Capital Management applies when managing non-directional investment portfolios, with a focus on risk management and market analysis. The firm's investment objective is to develop structured investment approaches grounded in portfolio construction, risk control, and long-term capital growth. Professional portfolio managers understand something many investors don't. Their first objective isn't maximizing returns, it's preserving capital. Capital preservation creates opportunity. If you avoid large drawdowns, your portfolio requires much smaller gains to recover. Consider this: lose 10% and you need approximately 11% to recover. Lose 20% and you need 25%. Lose 50% and you must earn 100% just to break even. Large losses become emotionally more difficult to overcome. Position sizing helps prevent those devastating setbacks. So how do professional managers determine position size? Rather than allocating based on emotion or conviction, they typically establish predetermined risk limits. Some funds limit any single position to only a few percent of the total portfolio value. Others define risk based on the maximum acceptable loss rather than the amount invested. For example, a professional fund manager is managing a $100,000 portfolio, might decide that no individual trade should risk more than 5% of the entire capital. That means that the maximum acceptable loss on any single position would be $5,000. This keeps one mistake from becoming a catastrophic event. Position sizing also improves emotional discipline. When positions become too large, emotions become amplified. Investors begin tempted to sell too early, hold positions too long, or make impulsive decisions driven by fear or greed. Appropriately sized positions allow investors to think rationally instead of emotionally. Good investing requires clear decision making, not constant stress. Risk isn't determined simply by the number of investments you own. It's determined by how much each investment can impact the entire portfolio. For investors using options or alternative investment strategies, position sizing becomes even more important. Leverage can magnify both gains and losses. Professional managers often calculate portfolio heat to ensure overall exposure remains within acceptable limits. Rather than evaluating each trade independently, they assess how every position interacts within the portfolio. The goal is to maintain consistent risk regardless of changes in the market. Now here's an important mindset shift. Successful investors don't try to hit home runs. They focus on consistency. Small gains accumulated over many years. Compounding works best when capital remains intact. Position sizing helps keep you in the game long enough for compounding to actually work. If there's one lesson to remember, it's this: every investment begins with risk management, not return expectations. Position sizing is one of the simplest tools available, yet it has one of the greatest impacts on long-term investing success. Before placing your next investment, ask yourself one question. If this investment doesn't work, how much of my portfolio am I willing to lose? The answer may matter far more than which investment you choose. Hey, to learn more about Theta Bridge Capital Management and our investment strategies, risk management approach, and portfolio construction process, click on the links below in the description box.